Hello and welcome back. In this lesson we are going to look at trading profit adjustments. Now what trading profit is from your accounting studies. You have been studying accounting for a while now. In your accounting, if you remember, you take the income, then you deduct the expenses, then after deducting the expenses then you have something called gross profit, then you deduct some more expenses, and the final amount which you get is called net income. Before deducting net income, you also deduct some interest as well, and you deduct some tax too, right? So that's why some of the profit is called before interest and tax, and some of the profit which was after tax is called after tax profits, and you can call that net profit as well, right? Now, while in making the trading profit statement in accounting, you were considering the only accounting aspects. So you were deducting all the expenses which incurred for the business. Excuse me. So you were not considering any tax aspects. So you were making the accounts, you were deducting the expenses, you were adding the incomes, and you were not thinking about any tax aspects. Whereas when the tax date has come, when you had to return, when you had to submit your tax returns, you have given your accounting statement, your trading profit statement, to your accountant. Then your accountant has seen it, and he said, all right, okay, this is all right. Although this this statement has been made according to accounting requirements, but as far as tax authorities, HMRC is concerned, HMRC might have to make some changes into it. Now, why does HMRC want to make changes? Because while making the accounting statement, while making the income statement for trading profits, you have deducted all the expenses which were incurred for business purposes. But HMRC says some of the expenses you should not have deducted as far as taxation is concerned. So what we will have to do is, we will take the income statement from our accounts, and you will write down the net profit, which will be in the end. So you will write down the net profit in the end. So you will take the net profit. All right. So we will add the net. So we will take the net profit from our accounting records. All right. So that is our ultimate profit after deducting all the expenses above that, and above all it will be the sales, then the expenses, then the net profit. All right. So that is our net profit. So while making the tax trading profit, so we will take the net profit and we will add the expenses which are deducted before. All right. So you will add the expenses. So will we add all the expenses or some of the expenses? We will only add the expenses which HMRC say should not have been deducted in the first place. So we will add back all the expenses which HMRC says should not have been deducted in the accounts as far as taxation is concerned. All right. So that's the way to do the trading profit for tax purpose. So we will have to make some adjustment to the trading profit of accounting. All right. So that's why it is called trading profit adjustments. Now I will just share the screen with you. Here you go. I've shared the screen. Page 21 it is, and chapter 7 it says. It is trading profit adjustments. Now what we will have to do is we will take net profit before tax as per accounts. So you will take the net profit before tax as per the accounts. Then you will have to do some adjustments into it. So what adjustments? First of all, you will add the expenses which are not deductible, which should not have been deducted in the first place. So you will add them back, right? After that, you will also add the incomes not charged in the accounts which are taxable. So while making the accounting records, some of the incomes you have not written there, which should have been written. So while making the tax records, you will write down them incomes as well. So you will add some expenses, you will add some income as well, which you forgot to add, or which you did not add, which you didn't know will be taxable. Then you will deduct something out of it, the incomes on which you do not have to pay any tax. So you will deduct them incomes. So income included in accounts which are not trading profits, so it will be deducted. Then you will also deduct the expenses which are charged in the accounts, which are not charged in the accounts, which are deductible. So you will also deduct them expenses which were not charged in the accounts. So there will be 4 adjustments. Now you will look at each of them in turn. Below that, as I will move the screen below, it says first of all you will have to add some expenses. So what are the expenses that were charged in the first place, but you will have to add them back. Now this is a huge list of expenses. First of all, it says fines and penalties, depreciation, amortization, general provisions, bad debts, capital expenditure, fee incurred in acquiring new assets, fee incurred in issuing new assets, new shares, and gifts to customers costing more than £50 per donee. More than £50 per donee. Gifts to customers which are food, drink, tobacco, these will also be added back. Subscription and donation to political party, private and personal expenses, entertainment expenditure. Now these entertainment expenditure not for employees. So if they are entertainment expenditure for the employees, then them will not be added back. So only the entertainment expenditure to third parties will be added back. Please remember. It says proprietor's salary, the owner's salary, or interest on capital, private elements of the expenditure relating to proprietor's car, telephone, etc. Then it says payment that constitute a criminal offence. So if you have made a penalty, then you are paying that. That will also be added back if it was deducted in the first place. Then it says private element of expenditure relating to proprietor's car, payment that constitute a criminal offence. Sorry, we have already seen it. Then it says 15% of leasing charge of car emitting more than 130 grams. So if the car is more than 130 grams, you will add back 15% of that leasing charge of that. All right. Then after that it says loss on sale of assets. Loss on sale of assets are called capital losses. We will see later when we see the capital gains chapter. You will see the capital losses there. All right. Now this is a huge list of the things which will be added back. Please remember, as far as F6 is concerned, this list is very, very important, and I would say very, very important, because you will get easy marks, because you just have to memorize this list and you will be getting some easy marks. So examiner could give you 3 or 4 things out of this list, and you will just need to add them back, and each adding back will earn you half mark. Say for example, if there is a depreciation, and depreciation is very common in the exam, it will almost always be in the exam. So you will just need to see depreciation, add it back. It is a straight, easy half mark. If it is amortization, add it back, another half mark. Likewise, you can earn easy 2 or 3 marks if there are about 4 to 6 items given in the exam. Right? Now there is another list just beneath that you will have to add as well. It is income not charged in the accounts which are taxable. Now these were the incomes which were not charged in the accounts, but which you will have to add, and it is a drawing by the owner, by the proprietor. If the business owner has taken something out of it, that will be added at the market value. All right. Then it says you will have to deduct some expenses as well. These were the expenses which were not deducted in first place. These were the incomes which should not have been added, so we will deduct that as well. So less income, profit included in the accounts which are not trading profits. So profit on sale of asset, capital gain, this is not trading profit, is it? Then rental income from property, it is property income, not trading income, is it? Then premium received in grant of lease is also property income. Interest received is the interest income. Dividend received is a dividend income. So these are all non-trading income. So if there is any non-trading income in the pro forma, in the accounting income statement, then you will have to deduct them as well. All right. And on page 22, if you move to page 22, there is another list as well. Expenditure not charged in the accounts which are deductible. So these are allowable expenditure, and there is only one, which is capital allowances. So this is also the thing that you will have to deduct. Now capital allowances, we will see in next chapter, I think. Capital allowances is just a depreciation on the assets. So in taxation we call it capital allowance instead of depreciation. All right. And in the note it says any expense not in the above list must be ignored as irreliable, and rarely, if the deductible expenses are not included in the accounts, then it must be deducted. Alright? Now if you move to next page, please, it says another thing, cash-based calculation. Next page, please, on page 23. Now this is the scheme which is introduced only for the small businesses. Small businesses, if they choose, if they want to, they can use the cash basis. Now if they use the cash basis, what is the way to calculate the trading profits as far as taxation is concerned? Now they may do like this. They will take the sale of the goods or inventory and sale of plant and machinery. After taking these two, this is their income, and what will have to deduct their expenses. What are their expenses? Allowable business expenses. Now revenue expenses are which are wholly for businesses can be deducted from this one. Purchase of goods or inventories, purchase of plant and machinery, and approved mileage allowance. Now approved mileage allowance, you know that. What is approved mileage allowance? Up to 10,000 miles it is 45 pence, I think, and above 10,000 miles it is 25 pence. So you will have you have the option to deduct that as well. Alright? So that is approved mileage allowance. After that you will see the trading profit or loss. Alright? And then in the end there are three notes. Now in the second note it says, please read the second note. Under cash basis, only allowable business expenses can be deducted. And it says see notes page 18. Now this is not page, you can't see it on page 18. Please cut this one. This is a mistake. Please make sure you just cut this one out. Right? So only allowable business expenses. Now what are the allowable business expenses? As I explained earlier, only expenses which are wholly attributable to the businesses and which are revenue expenses can be deducted. Alright? But above that, in the first note it says, under cash basis, no capital allowance is claimed and no capital expenditure is added or deducted except sale of the plant and machinery or purchase of it, excluding motor cars. And the last note it says, under cash basis, motor expenses are not allowed, whereas approved mileage allowance for expenses travels can be deducted. Alright, so you will have to remember these things. Now that is end of this chapter. Now if you could please move to, hang on, we will have to see another chapter today, which is national insurance contribution. Now if you move to page 30, please. On page 30 there is something called national insurance contribution. Hang on, in fact it is yeah, it is page 30, I think. Chapter 12, please. Chapter 12, National Insurance Contribution. Alright? Now, it says National Insurance Contribution. If you're living in the UK, you know what national insurance is. If you're working for someone, then if you check your salary, you will find something called NI, National Insurance. If you're not working, still you know it. You can check it on your dad's payslip or your brother's payslip or your girlfriend's payslip. There will be something called the national insurance. The national insurance is another type of tax. One is called normal tax. You know what normal tax is. There are lots and lots of types of tax. And other tax is called national insurance. First question arises, why the government is collecting two types of taxes. One is normal tax, another one is national insurance. I might have explained you earlier, normal tax is for the benefit of people, normal people, like to pay NHS, to build the roads, to build the railways. So to do this stuff and to pay the parliamentarians as well. Of course, the money is coming out of our pockets. Another type of tax is national insurance. Now, national insurance is only collected for the benefit of the people. So it will be collected and it will be paid back to the very needy people, someone who is disabled, for example. So someone who is disabled, cannot work, will be paid out of national insurance contribution. So we are paying it for our insurance. So in case some of us or someone who we know may be disabled, so if someone is disabled, we'll get a government benefit. right? Now, if you are not living in the UK, you don't know what national insurance is. National insurance is another type of tax, so you do not have to think about it much. It is just another type of tax. So government collects this tax, and government then pays it back to the different people who are in need. Say, for example, who hasn't got a job, or someone who needs a child care allowance, so we will have to pay them, all right, in the shape of national insurance. So that is why it is called national insurance. The government collects it. Now, what is the rate of national insurance and how can we calculate it? Please move to your page 31, as I've already shared the screen with you anyway. So you can see on page 30, I think it is. Yep. It might be some other page number might be different on your notes, but it is chapter 12, national insurance contribution. Now, there are different types of national insurances from class 1 to class 4, and there are two types of it. One is for employee, another one is for employer. So if you're working for someone, you will have to pay national insurance, and if someone is working for you, then you will have to pay national insurance. Now, first one is class 1 employee, or class 1 primary. Now, as it says in the name, it is class 1 employee, so it will be paid by the employee, all right? Up to 8,060, it says there isn't any tax, so you will not have to pay any tax if you are earning 8,060 per year. If you are earning 8,060 to 42,385, it is 12%. Then above that, it's 2%. Say, for example, if someone is working for you and you are paying them salary, then you will have to pay class 1 employer insurance. And up to 8,112, you will not have to pay nothing. Then above that, you will have to pay 13 and 8%. However, you can claim £2,000 employment allowance. Now, this employment allowance is just one single lump sum, 2,000. Say, for example, if 10 employees work for you, then you will still get just £2,000. Even someone, just one single employee works for you, you will still get £2,000 employment allowance. That is what you can deduct out of total. Now, another one is class 1A. It is only paid on the benefits. Say, for example, if you are working for someone and you are getting paid in shape of salary, but you are also getting paid some benefits as well. All right. Now, this is on the benefits only, and it is paid by the employer, not the employee. So your boss will pay class 1 employer and class 1A as well. Then the next one is class 2. It is paid by self-employed. There are two kinds of people: someone who is doing a job and someone who is doing a business. So someone who is employed is working, and someone who is self-employed is working for them own self. So someone who has their own business is self-employed, someone who is working is employed. So class 2 is for people who are self-employed. Now, it is standard rate 280 per week, and if the earning is 5965 or less than that, then you will not have to pay 280 per week. You will not have to pay nothing, right? Or if you are getting the state pension, and still you will not have to pay anything, all right? And the last one is class 4 NI. Now, class 4 NI is only paid on the profits by the self-employed people, and you will only have to pay on annual profits. The rate is given from 8,060 to 42,385 is 9%, and above that is 2%. Now, these rates, which this table, will be given to you in the exam, so you will not have to pay. You will not have to worry about it, that what the rates are. However, what you will need to worry about is you will need to differentiate between these two. It is very, very easy, and it is highly examinable in the exam. So please make sure you just know what the difference between what the who has to pay class 1, who has to pay class 1 secondary, who has to pay class 4, and who has to pay class 2 and class 1A. So you just need to differentiate between these. Rest will be given to you in the exam anyway. Tax table will be given to you in the exam. You will be given that up to 8,060 is nil and blah blah blah. You will be given that. So it is these are very easy marks. Please make sure you just memorize the difference between all these, who has to pay which one. So that is it. You do not have to worry about anything else. All right. You just need to worry about the difference between these. right? The table will be given to you in the exam. All right, so that was it for today. We have covered our trading profits and the national insurance contribution. All right, and the national insurance contribution is only paid by employees, self-employed, and the people, the bosses. So someone who we are working for. Say, for example, if I am working for AccountancyTube, I will have to pay Class 1 NI. AccountancyTube will have to pay Class 1 Secondary NI and Class 1A NI as well if AccountancyTube is giving me some benefits. Now, AccountancyTube may have to pay Class 4 NI on annual profits if they are self-employed. So likewise, other NI as well. Right, that's it for today, and we will see more stuff of ACCA F6 taxation in the next lecture. Till then, goodbye.